this is Rainer and it's so good to be back. So yeah, this is the weekly market analysis, and I've actually been inactive for the last, I would say, the last 3 weeks. Reason being that the markets was actually pretty quiet due to the festive season, so not much trading for me during the December holidays. So now that we are back for a brand new year, I'm actually quite excited to share with you what I think of the markets. So today, this week, I'll be looking to cover namely 3 things. The first being crude oil due to its massive downtrend, and next we'll be covering euro dollar, followed by gold. So let's roll. So this is the monthly chart of crude oil, and let's have a look at it. So looking at structure, we can see that the high tested in recent years was the high of 150 over here, followed by 128 over here, and we have a significant low at $35 over here. So as you can see, this year, or the last few years, what crude oil did was they had this some sort of a wedge looking pattern. So when it broke out of it, we see price being very bearish and trading lower rapidly, right? This shows that the momentum is actually still towards the downside. You look at the monthly candles, all right, have a clear look at it. You can see that for the last 1, 2, 3, 4, 5, 6 months, right, for the last half a year, crude oil has been trading lower on a monthly basis. So how low could crude oil go? So I believe that most traders around the world are actually looking at this level, which is actually the $35 level. Reason being that this was the level during the 08-09 crisis, right? This was the low that was being made before it rallied towards the 128 level over here. So I would say the $35 will be a significant level, and definitely a level to pay attention to. So now that you know the background story of crude oil, the recent prices it traded, the bearish momentum towards the downside. So the next question we would have is actually, how do we look to get short crude oil? So at that, we'll go on to the next chart. So this is the daily chart of crude oil, and I've actually plotted the 20 and 50 period moving average. So looking at the 4 hour, we can see one thing, right? You can see that price has been respecting the 20 and 50 period moving average over here. So it's respecting pretty well. And right now, you can see that actually there's a slight resistance being formed at this level over here. I would say somewhere around the 51 level. So for those who are looking to get short as early as possible, what they can look to do is actually place a sell limit order at this resistance over here with a stops of 2 ATR. Right? That's one possible scenario. Now, I want you to consider this thing, because I get a lot of questions from traders having this question, right? Say for example, that you went short at this resistance here and price traded higher, hitting your stop loss, right? You hit your stop loss. Then the next question you get is, Rainer, is the trend over? Yeah, that's what they usually ask me, when they get stopped out of their trades, hitting the 2 ATR stops, they ask me, Rainer, so is the trend over? So in this particular scenario, I want you to think about this, alright? Just because you got stopped out on a 4-hour chart does not mean that the trend is over. So let me repeat that once more. Just because we know that the overall trend of crude oil is really bearish, and just because you got stopped out on a trade on crude oil, particularly on the 4-hour chart, does not mean that the trend is over. Why do I say that? Now, have a look at the daily chart. So this is the daily chart, and on the 4-hour chart, you'll probably be looking at short somewhere around this black line over here, and your stop loss will be at this second black line over here. So if price were to trade up higher, hitting your stops at this level over here, does that look like the trend is still over? Because looking at the daily chart, the trend is still clearly intact, and judging from the EMAs, it seems to be respecting the 20 period moving average pretty well. So just have a look at it. Tested twice, thrice, 4 times, 5 times, and there's a possibility you could actually test for a 5th time before heading lower. So no, just because you got stopped out on the 4-hour chart does not mean that the trend is over. In fact, the trend still seems pretty strong towards the downside based on the daily chart. But the reason I say that you can get short on the 4-hour chart was because for traders who are actually eager to get short, to be more aggressive, that is actually a potential consideration. So if not, the daily chart still provides an ample shorting opportunity as well, based on this chart you can see right in front of you. So yeah, that's a question that I would like to address to most traders out there. So nonetheless, for example, if I were to short on the 4-hour and I were to get stopped out, the daily chart would be my so-called re-entry time frame to get short on crude oil. So that's my plan for crude oil, and I hope you guys find this useful. So moving on, next we'll be looking at the euro dollar. So this is the chart of euro dollar, not as bearish as crude oil, but still bearish towards the downside, enough to warrant us to get short. So this is the monthly chart of euro dollar, and you can see the significant high made this year was this level over here, the 1.4. And if you notice, price actually trading into this area of support around the 116 level around here. So yep. So another common question I get by traders is this: right now, so euro dollar is bearish, but now it's trading into a level of support. Would you look to turn long, or would you look to stop shorting the euro dollar? And here is my thing: I will still continue shorting the euro dollar despite it coming into a long-term support, because the reason being is very simple. In fact, I already short the euro dollar, so now it's just a matter of scaling in. So I will still scale in continuously, because since I have a bearish view, I would feel that, or I would think that support level will be broken. So for example, I were to short somewhere near the support and I do get stopped up for loss, I lose this 1R. But just what if, think about this scenario, what if the support level breaks? What is the potential downside now? So you're risking 1R in anticipation that the support level will break. And if it does break, the multiple of R that you'll get back in return is, I would say, is infinite, because you really don't know how low it's going to go. So it's risking 1R for potential of infinite R. I would say that's a damn good risk-reward ratio. So it's definitely a trade, I would think. And the next question is, where would I look to get short euro dollar, right? So okay, moving on to the next chart is where I'll look to short the euro dollar. So again, the 4-hour chart, 20 and 50 EMA. You can see that the price is respecting the 20 EMA. You can see it over here, over here, over here. This one is almost there, quite close. And right now, price is here once more. And again, I'll look to have stops of 280 here. And once more, if you do get stopped out, it does not mean the trend is over. It could just simply mean that we got in at a bad entry, and you could look for further opportunity to short should you get stopped out. So because that's what I always do. If I believe the trend is still intact, I short once, I get stopped out, I'll reevaluate. Is the trend still there? If the trend is still there, I'll look to reshort, possibly on the same time frame or a higher time frame. So that's my thought process on how I usually trade the trends. So that's for the euro dollar. And last but not least, I'd like to cover gold, alright? Not because that it is trending, but rather it is a typical example of a product that I will stay out of. As a trend follower, I would like to trade trends. But if a pair is not trending, then that is a product that I will stay out of, and gold happens to be one such product. So looking at this, so we can see that it is in a range of 1250 and a low of, I would say, somewhere around 1130 over here. So within this range, gold can go up to the resistance, come back down to support before rallying up higher. That's a potential scenario, but I'm actually not keen in it. I would only be keen in gold if this happens, right? If this is the resistance, this is support, and if gold does break out of the resistance over here, that's where I'll look to be bullish on gold and look to get long on gold. And similarly, if gold does break out towards the downside, I would actually be bearish on gold and I'll look to get short on gold. In the meantime, while gold is still being contained between the 1250 range and the 1130 support of the range, I would not be keen to trade gold from a trend following perspective. I'll just leave this pair out and look for other trading opportunities in the other markets. So yep, that's how I go about trading markets, identifying trends, staying out of the range bound markets, and that's what I do. So yep, this is all I have for this week's market analysis. I hope you guys find it useful. Feel free to leave any comments if you have any questions, and I'll be glad to answer them. So with that, I wish you guys good luck and good trading. I'll talk to you soon.